I'm Rafia Hassan, Chief Investment Officer at Wipfli Financial Advisors. Today, I wanted to share some highlights on markets in the first quarter of 2021. A few of the key developments that impacted markets in the first quarter include vaccine distribution ramping up. As of the end of Q1, 16% of the US population was fully vaccinated. The fiscal stimulus bill of 1.9 trillion that includes direct payments to individuals. This additional stimulus raised GDP growth estimates for 2021 to 6.5%. And that, combined with supply chain concerns coming out of the pandemic, has spurred inflation fears for many investors. We also saw Treasury yields rise in a pretty big way in Q1. Now let's turn to market returns for the first quarter. Equity markets had a solid start to the year. Overall, the US market was up 6.3%. A strengthening US dollar relative to international currencies weighed down returns for US investors in international markets. But both international developed and emerging market stocks experienced positive returns in US dollar terms. On the fixed income side, most investment grade fixed income sectors experienced negative returns pressured by rising interest rates. The US bond market was down 3.5%. Rising yields also hurt emerging market bonds, which become less attractive to investors when yields in the US go up. On this next chart, we get more granular in terms of specific segments within the stock and bond markets. Value stocks generally outperformed growth stocks across the spectrum of global equity markets. US small cap value stocks were up over 20% in the first quarter and were the best performing asset class. On the bond side, the best performer among fixed income was US high yield, as we saw credit spreads continue to narrow. Looking ahead, with significant infrastructure spending on the horizon, inflation fears may continue to dominate headlines. It's important to remember that a 2% inflation target for the Fed is a far cry from the runaway inflation experienced in the 1970s, and that some of the impact of supply chain disruptions will be transitory. So while we might see inflation bump up over the next few months, it is not necessarily cause for alarm. Additionally, investors should remember that stocks tend to provide a strong hedge against inflation. Thanks for joining us. As always, if you have questions, feel free to reach us at wipflifinancial.com.